Good morning and welcome to The Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Tuesday, August 25th, 2026, and this week is stacked. Nvidia reports tomorrow in what could be a $280 billion market cap event. PCE and GDP land in the same session. Wednesday, Bitcoin has crossed $80,000 for the first time in 3 months, and Fed Chair Warsh makes his Jackson Hole debut Friday. A lot to get through. Lizzie, options markets are pricing in a 5.4% move on Nvidia tomorrow. How should traders be thinking about positioning ahead of that print?
Morning, Robert. This is the print of the quarter, and the setup is genuinely tricky. Nvidia snapped a 7-day losing streak in pre-market this morning, which tells you some repositioning is already underway. But that implied 5.4% move cuts both ways, and the direction really hinges on the forward guidance rather than the headline beat. The smarter play for most traders is to avoid large directional bets going into the number and let the report speak, with investors focused on revenue guidance, chip demand commentary, and what hyperscalers are saying about AI capital spending. That forward commentary is what actually moves the broader tech sector. On the S&P 500 and SPY, our technical bias is neutral heading into this session, with momentum sitting right in the middle of its range and neither building to the upside nor rolling over. So the tape itself is telling you to wait for a catalyst, and Nvidia tomorrow is exactly that.
Bank of America flagged 8 semiconductor stocks as enhanced buying opportunities alongside Nvidia. Marvell, Micron, Lam Research, AMD, Intel, Analog Devices, ON Semiconductor. Does that list feel actionable, or is the trade already too crowded?
Positioning is genuinely heavy. Semis are running 13% overweight versus the S&P 500, and BOFA themselves acknowledge meaningful near-term downside risk to the SOX index before they'd call valuations unjustified on fundamentals. So the setup carries real short-term risk. That said, their longer-term argument around a 70% earnings growth rate through 2028 at 20 times forward multiples is a compelling fundamental case if you have the patience for volatility. Lam Research and Micron specifically stand out as the more measured picks. They're the picks and shovels names in this cycle, benefiting from AI data center build-out without carrying the same concentration risk or the earnings quality concerns BOFA flagged on Nvidia around its customer financing arrangements. So the thesis there is steadier and less binary than owning Nvidia directly into a major print.
Salesforce and CrowdStrike are also reporting this week. What are traders watching in those prints?
Those two together give you a real-time read on enterprise software spending and cybersecurity budgets, the most important downstream indicators for whether AI investment is translating into broader tech demand beyond chips. So if Salesforce signals enterprise budgets are holding and CrowdStrike shows cybersecurity spend is intact, that's a meaningful positive for the entire software sector. Intuit also reports after the bell today, already under pressure after cutting revenue guidance and slashing 17% of its workforce due to AI competition eating into TurboTax. And that's a show-me situation where stepping in front of the print feels like low-quality risk. Dollar General is also on the docket this week, and given that consumer staples have underperformed the S&P by nearly 15 percentage points over 6 months, that print is a direct read on whether lower-income consumer spending is holding up at all.
The flash composite PMI came in at 56 this morning. Solid number, but it's complicating the Fed's path and sending futures slightly lower. Which sectors are most exposed to that rate uncertainty?
Banks, real estate, and small-cap stocks are the most directly exposed. Those are the rate-sensitive names that need lower borrowing costs to see multiple expansion, and a PMI at 56 with services at 56.8 signals the economy is running hot enough that the Fed has less cover to cut, keeping pressure on anything interest rate sensitive. The 10-year yield dipping toward 4.71% this morning provides some relief. But strong economic data, combined with still elevated yields, is a difficult backdrop for that group. And on the defensive side, while names like Altria stand out with an 88% gross margin and nearly 44% free cash flow margin at just 11.5 times forward PE, the broader consumer staples sector is not where momentum traders want to be in this environment.
Steve, PCE inflation and the GDP, second estimate both drop tomorrow. Significant macro firepower in one session. What are you watching most closely in those two prints?
Robert, tomorrow is one of the heavier macro days of the month, and the PCE print is the one I'd prioritize because it's the Fed's preferred inflation gauge, and it arrives just 48 hours before Fed Chair Warsh speaks at Jackson Hole. So any surprise in either direction on core PCE will immediately feed into market expectations for what Warsh signals Friday, and given that today's strong PMI data already complicates the rate picture, a hotter-than-expected PCE reading could meaningfully push back rate cut expectations and add real pressure to equities. The GDP second estimate for Q2 2026 is also due tomorrow. And while second estimates rarely deviate dramatically from the advance reading, any downward revision to growth combined with sticky inflation would raise genuine stagflation concerns that markets would need to reprice across all asset classes heading into that Jackson Hole speech.
Initial jobless claims are due Thursday, forecast at 208,000 against a prior of 206,000, and the last print actually came in below expectations. Is the labour market still holding up as well as that data suggests?
The claims data has been remarkably resilient. The most recent print for the week of August 15th came in at 206,000 against a forecast of 210,000, continuing a trend of below consensus readings that signals the labor market is not deteriorating at the pace some had feared, and Thursday's reading for the week of August 22nd is expected at 208,000, a very modest tick higher but still historically low. That consistency matters enormously for the Fed. It means Warsh arrives at Jackson Hole Friday with a labor market that hasn't cracked, giving him less urgency to signal cuts, and combined with today's strong PMI, the macro picture he's working with simply does not make the case for near-term easing. Consumer confidence is also due Friday. The Conference Board reading is forecast at 51, down from a previous 55.2, and the University of Michigan sentiment reading already confirmed that same 50 level in its mid-month print against a forecast of 54 points. So we're seeing a consistent softening in how households feel about conditions, though with Warsh speaking the same morning, that confidence data will likely function as supporting context for whatever tone he strikes rather than a standalone market mover.
Lizzie, flip it over to crypto. Bitcoin crosses $80,000 for the first time in 3 months, up 28% in 8 days. How are you reading this move?
This is the debasement trade in full force. The Treasury's decision to double its long-dated bond buybacks from $2 billion to $4 billion per session has shifted pressure from the bond market to the dollar, and investors are treating that as a liquidity signal that makes hard, scarce assets like Bitcoin and gold significantly more attractive as sovereign debt hedges. The institutional dimension here is notable. Spot Bitcoin ETFs pulled in nearly $1.9 billion in weekly inflows, the largest since October 2025, and crypto-linked equities have moved sharply with them. Strategy up 36%, Circle up 43%, Coinbase up 16% over the past month. Analysts at Standard Chartered and IG are pointing toward a 95,000 to 100,000 range as the next target if momentum holds, though the rally has already delivered 28% in 8 days, so the entry question is very real. And Polymarket has the probability of hitting $85,000 this month at 41%.
The technicals are flashing caution though. Bitcoin, Ethereum, and Solana all look stretched. Does the macro story override those signals?
Our technical bias on Bitcoin is firmly a void for new long positions right now. The momentum indicators are in extremely overbought territory, with price pressing right up against the upper Bollinger Band, a condition that historically signals exhaustion and mean reversion risk rather than a clean continuation breakout. Ethereum carries a lean bearish signal near $2,475, with similarly stretched momentum, suggesting the rally is getting overextended, while Solana near $19 is pressing the same upper resistance zone, with an even more extreme overbought reading. And although a volume surge at over 2.6 times average shows genuine conviction, at these stretched levels, that momentum can reverse sharply the moment sellers step in. The macro thesis driving this rally is structural and compelling, but the higher probability approach right now is to wait for a pullback or consolidation before adding exposure. Buying into a 28% 8-day move against those technical signals is a low-quality entry regardless of how strong the fundamental story is.
That wraps up today's Morning Bell. A reminder, this is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.